You've got a big IRA. It probably feels pretty good to log in and see that number. Congratulations. Six, seven figures. Fantastic. But here's a hard truth that most pre-retirees don't often think about. Every single dollar in that traditional IRA or 401k is not actually yours. That's because you have a silent partner and you don't even know exactly what percentage that silent partner owns. And you won't find out until you start taking withdrawals. And you may have guessed that silent partner is the IRS. And today, in the Retirement Income Lab, we're going to put that relationship under the microscope and answer a simple question. How much of your IRA really belongs to you? And how much belongs to the IRS? I'm Patrick Huey. I'm a certified financial planning practitioner. And let's get to work in the lab.
You're entering the Retirement Income Lab with certified financial planning practitioner Patrick Huey, where your questions about retiring and staying retired get answered. No hype, no stock tips, just data, discipline, and the right decisions to help you make retirement a reality. You ready? Good. Let's get to work in the lab. Here's your host, Patrick Huey.
And welcome back to the Retirement Income Lab, where high-saving professionals turn portfolios into paychecks that they can actually live on. Now, if you're within about 5 years of retirement or just into it, this channel and these videos, well, they're for you. Because we stress test real-world retirement income decisions so you don't have to test them out there in the real world. If you watch this and you think, hey, that sounds like my situation, remember, you can always schedule a retirement income lab assessment with me at victoryindependentplanning.com/contact. And we'll talk more about that at the end of this video. For now, let's talk about that silent partner. Let's talk about why your IRA balance is not all yours. Now, when you look at your IRA or your 401k, you see big round numbers. Maybe it's 750,000, maybe it's 1.2 million, maybe it's more. Again, congratulations, good for you. It's important to celebrate that savings. And it's very easy for your brain to then say, hey, that's my money. But with pre-tax accounts, traditional IRAs and traditional 401ks and 403bs, that number is really a joint account between you and your Uncle Sam. You got a tax break up front when you contributed. You may not remember that, but you did. And in return, the IRS gets to tax every dollar that comes out. Now, you don't get to choose whether to partner with them. You agreed to that relationship the moment you put pre-tax money in. So now the only questions are, what share of the account will ultimately go to taxes? When will the IRS take it? And is there anything that you can do now to make sure that you and not that silent partner get the best end of the deal? Today in the lab, let's start with a very simple example. Let's say you have $1 million in a traditional IRA. Now, if, just for illustration, every dollar that you withdraw is taxed at a flat 22% combined federal and state rate over your lifetime, that means 220,000 of that million effectively belongs to the IRS, and 780,000 effectively belongs to you. That means the $1 million on your investment statement is really a private partnership where you get 78% and the government gets 22%. Now, of course, real life is never that neat. Different portions may be taxed at different rates. You might be in a lower bracket early in retirement and a higher bracket later, or vice versa. Your required minimum distributions, RMDs, could push you up into a new bracket in your 70s or even your 80s. And of course, future tax laws could change the percentages altogether. But the point is this: the big round number is a before tax number. And the only way to know how much of it truly belongs to you is to think in terms of after tax value. Your real retirement income doesn't come from balances on a statement. It comes from what you keep after the IRS takes its share. Now, to make this a little more concrete, let's contrast three different buckets of money. First, pre-tax accounts. Those are, like we said, your traditional IRA and 401k and 403b. Second, Roth accounts. Roth IRA, Roth 401k. And third, taxable accounts. Those are your regular brokerage and even sometimes savings accounts. So, in your pre-tax account, you got a deduction going in. Again, you may remember it, you may not. But now every dollar coming out is taxed as ordinary income. You must take required minimum distributions starting at around age 73, whether you need the money or not. And this is where your silent partner has the biggest claim to your assets. Second, Roth accounts. In that case, you paid the tax up front. Your qualified withdrawals in retirement are tax-free, as is any growth that occurs in the account after you put in the money. There are no RMDs or required minimum distributions for you during your lifetime. And your silent partner's claim here is essentially zero, as long as the rules don't change. Third, taxable accounts. You invest after tax money. You might pay taxes on dividends and interest each year, which is why savings accounts are included here as well. And then you pay capital gains tax when you sell anything like a stock or bond or ETF at a profit. These tax rates are usually lower than ordinary income rates, but not always. And there's usually some tax drag, but it's not the same as a pre-tax IRA or 401k account. Okay, those are the three buckets of money, but why does this matter? It matters because when you step back and look at your entire balance sheet, not just how much have I saved, but where have I saved it, you start to see how much power your silent partner has over each of those pools of money, from kind of a lot to essentially zero. Two households with the very same balance can have very different realities depending on their account structure. So let me show you how this plays out with two simplified examples. In household A, we've got $1 million in a traditional IRA, nothing in Roth, and practically nothing in a taxable account. In household B, we've got $500,000 in a traditional IRA, $300,000 in a Roth IRA, and $200,000 in a taxable brokerage account. On paper, both households have $1 million in investments. But after tax, they're in very different worlds. Household A, almost every retirement dollar must pass through the full ordinary income tax system. Their RMDs, required minimum distributions, could push them into higher brackets as retirement goes on, and they have very little, I'll even say no, flexibility if tax laws get less favorable. Think about that. You essentially join a partnership ahead of time where you don't get to know what the rate that your silent partner will take from you is. It can change. So if you're sitting on $1 million IRA, there's some risk that taxes will eat into that more than you think they will right now. Let's go to household B. Remember, only half of their money is fully pre-tax. They have a Roth that gives them a pool of money for completely tax-free withdrawals. And they have a taxable account that gives them some flexibility, potential capital gains rates, and a source of cash that doesn't automatically spike their ordinary income. Now, if tax rules don't change, Household A would reasonably expect that their silent partner's share would be around 20 to 30% of their million over time, depending on their overall tax rate. But Household B could see much smaller effective percentages going to taxes. In fact, in households like this, we've often moved back and forth between the 12 and the 22% tax bracket based on tax planning. That's even though the total before tax balance between A and B is the same. Same million, but very different after-tax treatment. A very different after-tax life. So the most common mistake that I see high-saving professionals make with their IRAs and their 401ks is this. They ignore their silent partner until the IRS sends them a letter in their 70s that politely says, it's time to start paying us. That's the RMD notice, required minimum distribution. And at that point, your balance may have grown for 30 or 40 years. You've fewer levers left to pull, and large forced withdrawals can push you into higher brackets. And that increases the tax on things like your Social Security, and it can even raise your Medicare premiums. In other words, if you don't plan for your silent partner in your 50s and 60s, the IRS may end up taking a much larger share of your IRA in your 70s and 80s than you ever expected. And on top of that, your heirs will inherit a big pre-tax account that now has to be emptied within 10 years, often at their higher working year tax rates. That's not always the end of the world. But if you're trying to leave a meaningful legacy or simply keep more of your own savings for your own retirement income, then that's just not ideal. So what can you do? Well, we can look for planning opportunities, ways to shrink the IRS's share. You can't kick the IRS out of the partnership completely, but you can manage what their take is. Now, here are a few of the levers we often test here in the lab. We look at Roth conversions in your 60s. In lower income years, especially between retirement and required minimum distribution age, RMD age, which right now is 73, you may have additional room in your lower tax brackets. So if you're in the 22% or in the 12% tax bracket, but you're not completely filling it up with your current income, it may make sense to do that. Fill it up with extra income in the form of Roth conversions. Converting part of your traditional IRA to Roth in those years is like buying part of your silent partner's share at a potential discount. Think about that. If you're in the 22% bracket now, is it likely that tax rates will go down much in the future? Probably not. So you're locking in that 22% tax rate now. You pay the tax now at a known rate to create a tax-free pool of income and growth later on in retirement. The other thing we can look at is smart withdrawal order. Instead of just pulling from one account until it's empty, which a lot of times is the advice you'll find online, you can blend withdrawals from pre-tax, Roth, and taxable accounts. It's extremely powerful to do that. The goal is to meet your spending needs while smoothing out your tax bracket over time, rather than spiking them in any one single year. Draw a little bit from Roth, a little bit from your taxable account, and a little bit from your traditional IRA. Put it all together, you get the same amount of income, but you do it at a lower tax rate. The third thing we can look at are charitable strategies for those of you who are charitably inclined. If you give money using qualified charitable distributions, QCDs, from your IRA once you're eligible, which is at age 70 and a half, can send money directly to charity without passing through your tax return as income. What does that do? Well, it reduces your IRA and your future required distributions, as well as your silent partner's share, while you directly support the causes that you care about. For some households, combining QCDs, qualified charitable distributions, and other estate or donor advised fund strategies can materially change who ends up benefiting from their IRA. Lastly, coordinating your Social Security and your required minimum distributions. Claiming Social Security early or late can change your income picture and therefore your tax brackets during the years when required minimum distributions start. In some cases, delaying Social Security and drawing more from your pre-tax accounts earlier can actually reduce your overall tax bill over a full retirement. Think about that as winning on both sides. Why? Because you reduce your required minimum distributions by taking money earlier in retirement from your IRA, while you simultaneously delay your Social Security benefits, watching them increase and knowing that later on you actually get a cost of living adjustment as well. Now, none of this is about beating the IRS. It's about recognizing that they are, whether you like it or not, a partner in your IRA, and then making deliberate choices so their share is as small as the law allows. Now, let me give you a few questions to take away from this episode to ask yourself or your current advisor. When you look at your retirement accounts, do you think in before tax or after tax terms? And what do you really have available to spend over your lifetime after the IRS takes its share? How much of your total savings is in pre-tax versus Roth versus taxable? Are you heavily tilted toward the silent partner's favorite bucket, the pre-tax one? Have you looked at what your required minimum distributions might be in your early 70s, late 70s, and into your 80s, and how that might affect your tax bracket, Social Security taxation, and your Medicare premiums? Finally, have you explored whether Roth conversions, altering your withdrawal sequences, or charitable tools could shift the math in your favor? Listen, if the answer to most of those is no, guess what? You're not alone. But that's exactly why we run these experiments. Now, if you're watching this and thinking, I know I have a large IRA, but I've never really thought about how much of it belongs to the IRS or what my required minimum distributions will look like, that's a good sign that it's time to put your plan into the lab. Now, I'm a fiduciary, a certified financial planning practitioner, and I own Victory Independent Planning. And I work with high-saving professionals nationwide who are within about 5 years of their retirement or recently retired. And what we offer is a retirement income lab assessment. What that looks like is we'll map out your accounts by tax type, pre-tax, Roth, and taxable. We'll estimate how much of your IRA is effectively pledged to future taxes. We'll model what your RMDs might look like. From there, we'll let you know about strategies like Roth conversions or withdrawal sequencing that might be able to help maximize your after-tax retirement income. So if you'd like a second opinion on how much of your IRA really belongs to you and what you can do about minimizing the IRS's share, just go to victoryindependentplanning.com/contact and schedule a short call. That link is also in the show notes for today's episode. If you found this helpful, please subscribe to the Retirement Income Lab and also hit the like button. It helps more people find these episodes and this information. In our next experiment, we'll look at how much risk you actually need in retirement and how much risk will keep you up at night unnecessarily. Thanks for watching. See you next time in the lab.
This has been the Retirement Income Lab with certified financial planning practitioner, Patrick Huey. To stress test your own retirement income plan, visit victoryindependentplanning.com/contact and schedule your introductory call today.